Did any inflation ever end without a recession? Or is pain the toll booth you have to pass? That's the question. When prices sprint and wages chase, we all hope for a polite outcome. Inflation glides back to target, jobs stay plentiful, and the economy keeps humming. Economists call that a soft landing. History, most of the time, calls it wishful thinking. Not because central bankers are cruel, but because inflation is a coordination problem tied to time. Once price setters and wage bargainers expect tomorrow's dollar to be weaker than today's, they race each other. Stopping that race without slowing the whole stadium is hard. To see why, forget the jargon and picture the machine in plain English. Inflation has three main engines. One is demand running hotter than what the economy can produce, the classic too much money chasing too few goods. Another is supply getting worse. Oil shocks, broken supply chains, bad harvests, so the same money buys less. The third is expectations. People expecting prices to rise, so they raise prices preemptively and demand raises to keep up. If policy cools demand at the same time supply heals and expectations stay anchored, inflation can fall without a crash. If supply doesn't heal or expectations slip the leash, cooling demand often means cooling jobs, spending, and, yes, a recession. History's greatest teacher on this is the late 1970s and early 1980s. Inflation didn't just appear, it settled in. Two oil shocks, years of policy that tried to finesse trade-offs, and spiraling expectations made price growth stubborn. Paul Volcker chose to break the cycle with very high interest rates, not for a week but long enough to convince price setters that the game had changed. It worked, but the price was a deep recession. That's the hard landing template. When expectations are unanchored and supply is constrained, ending inflation without ending the expansion is like stopping a speeding truck without brakes. You use the guardrail. But not every episode ended that way, and that's where nuance and hope live. There are moments when inflation fell quickly without a formal recession, or with only a shallow dip that didn't scar the labor market. In the early 1950s, wartime and Korean War demand pushed prices up. When controls were lifted and the economy normalized, inflation cooled with only a brief and milder contraction compared to later cycles. Credibility mattered then too. After the Treasury-Fed Accord of 1951 restored the central bank's independence, markets believed rate policy would target stability, and expectations didn't run away. Another example often cited is the mid-1990s. Inflation was not raging, but the Federal Reserve tightened aggressively in 1994 to prevent it from taking off. Growth slowed, markets wobbled, but the economy avoided recession and inflation stayed contained. You can argue that's not ending high inflation, it's preventing it. Precisely. Prevention is easier than cure. There's a pattern inside those softer outcomes. Three conditions tend to line up. First, supply improves on its own or with help. If the inflation came from clogged ports or energy spikes, then repairs, new capacity, or falling commodity prices do real work. When more goods show up on shelves, less demand needs to be crushed. Second, expectations never fully detach. Workers and firms believe the central bank will stick with the job, so they don't build double-digit price hikes into every contract. Third, productivity surprises help. If output per worker rises, companies can pay raises without pushing prices as much, buying time for inflation to ease while employment holds. Now flip the pattern. Soft landings often fail when supply doesn't heal, so policy has to grind demand harder. When credibility is in doubt, so everyone front-runs inflation into wages and prices, or when financial structures are fragile, so higher rates trigger credit accidents that bleed into the real economy. That's why so many inflation endings are paired with recessions. The medicine that cures the fever can slow the patient. There's a quiet fourth factor: time lags. Rate hikes work through the economy like a slow tide. They raise borrowing costs, which cools interest-sensitive sectors first: housing, autos, capital spending. They change discount rates, which reprices assets, making households and firms feel less wealthy and more cautious. They bleed into the labor market last, as job openings shrink, wage growth cools, and only then do layoffs rise. If inflation is falling while those lags accumulate, a country can look like it's pulling off the soft landing until the tide finally arrives on shore. That's why calling the landing in real time is tricky. The scoreboard updates slow, the waves move fast. What about recent experience? In modern cycles, inflation has eased at times alongside surprisingly resilient job markets and continued growth. When that happens, it's usually because supply repaired much faster than textbooks assumed, ports unclogged, shipping costs collapsed, semiconductor shortages eased, energy prices retreated, and because expectations remained anchored enough that wage price spirals never hardened. But even in these friendlier paths, you can usually find pockets of pain. Interest-sensitive sectors stalling, corporate margins narrowing, credit conditions tightening. Soft landings are not pain-free, they're pain-contained. It helps to examine expectations more closely because they are the fulcrum that decides how much pain is necessary. If workers believe 2 to 3% inflation will return, and employers believe customers won't accept price hikes forever, they negotiate around a stable anchor. If both sides expect 6 to 8% inflation, they load that into contracts, and policy has to push harder to break the loop. Credibility isn't a speech, it's a track record. When a central bank does what it says again and again, expectations stick. When policy blinks, expectations slip, and the cost of bringing them back up rises. Another underappreciated lever is what economists call income policy. But in plain English, it's the social habit of how prices and wages are set. In some countries and eras, widespread indexation, automatically raising wages and rents with last year's inflation, cements the problem. Turning off those mechanical linkages can break the spiral without mass layoffs, but it requires coordination and trust that are in short supply during bouts of inflation. In other eras, competition does the job. When new entrants and innovation pressure firms, it gets harder to pass through every cost increase, and inflation cools as margins compress instead of employment collapsing. The structure of household and corporate balance sheets also shapes the landing. If most mortgages are fixed rate and long-term, higher policy rates bite slower. Households keep spending longer, and the economy has time for supply to catch up. If many loans float, rate hikes transmit immediately, and consumption snaps, often enough to tip into recession. If companies funded with short-term debt that must be rolled, the refinancing wall brings pressure on investment right when policy wants demand to cool. If firms locked in low-cost, long-term debt, they can ride out the tightening and keep staff employed while prices settle. Soft landings get easier when the financial plumbing buys you time. Energy is another pivot. Inflation driven by a shock to fuel and electricity behaves differently from inflation driven by consumer demand. When energy prices drop sharply because of new supply, warmer weather, efficiency, or demand destruction, inflation can fall in headline terms even if the underlying economy never hits recession. The early 1980s disinflation eventually benefited from oil supply normalization and conservation. More recently, shifts in energy markets can add or remove inflation pressure without changing employment in the same proportion. Soft landings love falling energy prices. Hard landings show up when those prices stay stubborn. So, did inflation ever end without a recession? Yes, in narrow windows for specific reasons, usually when supply tailwinds and anchored expectations pulled in the same direction as moderate policy tightening. But even those wins came with slower growth, softer profits, and a labor market that cooled around the edges. And when inflation was entrenched, when people behaved as if it would keep rising, non-recessionary endings were the exception. For you and me, the point isn't to win an academic debate. It's to translate the pattern into decisions. If inflation is falling because supply is healing, you don't need to bet on a crash to protect yourself. You need to survive a slower, choppier expansion. That means watching cash flows, not just headlines. Choosing fixed over floating where you can. Keeping maturities laddered so you're not forced to refinance at the worst moment. And favoring businesses, yours or those you invest in, that earn pricing power from quality, not from scarcity. If inflation is falling because demand is being hammered, the odds of a recession rise. And resilience looks different. More liquidity, less leverage, leaner inventories, and a plan for customers who suddenly care about price again. There's also a mindset prize hidden inside this topic. Obsessing over soft versus hard can become a spectator sport, like watching the Fed as if it were a single pilot landing a jet. In reality, we all have a yoke in our hands. Employers decide how quickly to raise or freeze wages. Landlords decide how much to push their tenants. Workers decide when to negotiate and when to retrain. Entrepreneurs decide whether to chase hot demand or build products that matter at any interest rate. These choices compound. When enough actors expect stability and behave like it, inflation ends with less wreckage. When enough actors expect chaos and lock it in, the economy gets the landing it priced. So the honest answer is this: ending inflation without a recession is possible but rare. It requires a lucky alignment, supply tailwinds, anchored expectations, sound balance sheets, and steady policy that moves decisively without panicking. When that alignment shows up, inflation can fade like weather. One day you notice the air feels cooler and prices have stopped lurching, and the job market looks normal. When it doesn't, the path is bumpier, and the economy pays up front for stability later. Either way, the personal playbook doesn't change much. Build room in your budget and your business for rates that stay higher than you'd like for longer than you expect. Prefer cash flows you control over stories you can't. Hedge the exposures that can sink you and ignore the ones that only make you uncomfortable. And remember the deeper lesson we repeat on this channel. Policy sets the stage, but behavior writes the ending. If this helped you separate headlines from mechanics, stick with money lore. We'll keep translating the big, messy story of prices and jobs into plain English you can use. So you're not guessing the landing, you're preparing for it.